talking away. That we have under U.S. GAAP specific rules that tells us how that we're going to treat these. So a change in an accounting principle is someone going from completed contract to percentage of completion, or going from FIFO to LIFO. All right, those are changes in accounting principles. So as you've determined thus far in the 35,000 pages of U.S. GAAP, there's lots of different options. Most of these options are adopted when you first set up a company. There are a number of really, really good business reasons to change midstream. So we'll talk about what you have to do in order to change one of those principles. The most common in this chapter is a change in an accounting estimate. You make estimates for warranty expenses, for bad debts. You make estimates for the number of years of useful life for property, plant, and equipment. Useful life on an intangible patent. What is the residual value of a piece of equipment when you finish using it? All of those can be changed and are commonly changed as assets mature. Maybe your customers are paying you at a much higher rate, so you don't need to estimate as much bad debt expense as you used to. So this occurs quite often. Third possibility is a change in a reporting entity. This is primarily either a consolidation. You take two companies and you put them together for a much, much, much larger company. I mean, right now, the Justice Department and the FCC are deliberating whether to allow Comcast and Time Warner to merge. They want to merge. They're two of the largest cable companies in America. And they want to combine and make one really, really big cable company. And the Justice Department, and now they've gotten the FCC involved. It was announced yesterday. So that's looking kind of touchy. But in the airline industry, over the last 10 years, there's been a multitude of mergers. Delta Airlines consumed Northwest Airlines. United Airlines consumed Continental. Most recently, just completed last November, Southwest Airlines acquired AirTran. All right? Another common way of reporting entities is to disinvest. Right now, General Electric is trying to sell GE Capital, which is their banking division that's been financing all sorts of items over the last 30 years. All right? They're trying to divest themselves of that. And I can't remember who they've got as a buyer. I want to say Wells Fargo, but I'm not sure. Anyway, and then the last one are just straight up errors. So these are the four types that we're going to talk about in this chapter. Mistakes happen. We all make them. It's part of being human. I joke in my classes that the day I stop making mistakes, I want temples built throughout the land. You know, big stone statues, Hawaiian shirt. You know, come up, lay Guinness at my feet. Be nice. So these are the ones. How do you treat these? Well, you're either going to treat them retrospectively or prospectively. Retrospectively is you go back in time and you change the prior year financial statements as if the change had occurred years ago. Now, in the case of a change in accounting principles, you have to do it retrospectively, because it would be misleading to present the 2013 financials under FIFO and the 2014 financials right next to it under LIFO. That wouldn't make sense. A change in a reporting entity. It would be very, very strange to see Southwest Airlines 2014 with all of AirTran added into it. They weren't quite as big as Southwest, but they were pretty large. They had a lot of aircraft. Next to the 2013 without AirTran. It would look like Southwest all of a sudden doubled in size in a year. They had a really, really good year. Sales increased 100%. All right, so both of those are retrospective. You have to go back and restate the 2013 and the 2012 if you're going to put 3 years worth of financials data in your shareholders report and your SEC reporting. Then you'd have to present all 3 years as if the AirTran acquisition had occurred prior to the earliest year. Okay? Prospective is the change in accounting estimates. This happens all the time. If you determine that your bad debt expense isn't 1.5% of sales, it's only 1% of sales now, then just simply change it for the current year and use the 1% going forward. You can leave last year's financial statements at 1.5. Okay? So those are prospective. And then lastly, errors are prior period adjustments. That's its own special category. And we'll talk about what you do with errors. This is what I just talked about. Change in accounting principle is retrospective, accounting estimates is prospective, and reporting entities are retrospective. They would not make sense otherwise in the case of changing accounting principles. I mean, if you were doing completed contract and now all of a sudden started doing percentage of completion, it would be very odd looking on your financial statements if you presented them side by side without changing the one. And then the prior period adjustment is the last one. All right, how do you retrospectively adjust a financial statement? Let's assume we change from LIFO, last in, first out, to FIFO. We determined that the cumulative difference in ending inventory is $70,000 increase, because under first in, first out, you're going to have the most current inventory still in ending inventory, so it's higher. There's also tax effects associated with that. Changing to FIFO, your cost of goods sold is going to go down because your cost of goods sold, cost of goods sold is going to go down because you're expensing now the oldest inventory in stock rather than the newest inventory under LIFO. So you're going to have to pay taxes on this increased profit, which is one of the reasons I don't believe the United States will ever adopt the International Financial Reporting Standards. Have I said that in here? Have I told you why? Right now, the IFRS, International Financial Reporting Standards, does not allow LIFO inventory. You can use specific identification, you can use average cost, and you can use FIFO. But you cannot use LIFO in the rest of the world. There are a number of companies in the United States that use LIFO, primarily in the petrochemical business, oil and gas and such, and pharmacy. These companies would be faced with billions, tens of billions of dollars worth of taxes due if they had to switch. Because the IRS requires that you must use the same inventory costing method for tax purposes as you do for book purposes. So you're not allowed to file your financials under LIFO, but your tax, or under FIFO, but your tax return under LIFO. All right? So that would be, and I've got a journal article on that from, well, it's about 2 or 3 years old, but still, it lists, I mean, Valero and Tesoro's on that list here in town. Huge amount of money that they would have to write a check to the IRS for if we ever adopted the international standards. So that's why there's a deferred tax liability issue here. And then the rest of it goes to retained earnings. It's the rare case that we get to that in errors that we get to actually make adjustments to retained earnings. And so this is retrospectively. You would make this back to the whatever comparative. If we're going to do the 2014 financial statements, you got to change 2013 to reflect this increased inventory and the decrease in cost of goods sold. All right? So here would be the comparative financial statements, 2014, now under FIFO, but we would add in the header as adjusted, because when we originally published 2013, we were using LIFO, and now we've made a change. And then here's the statement of retained earnings. So we've got that cumulative effect adjustment for prior periods that has to go in there. Changes in estimate. This one, as I said, is very, very common. The authors are saying almost every number that you've got on the balance sheet involves an estimate of some sort. The only difference would be cash. But everything else, you're estimating useful lives, you're estimating residual values, you're estimating your liabilities associated with warranty, bad debt, lots and lots of estimates. All right? So here's an example. These are prospective. So when you decide to change an estimate, you recalculate current year only and then go forward. So the example they're using is a $100,000 asset. We originally thought it was going to last for 20 years and have zero residual value. 8 years in, after we've depreciated at $5,000 a year, $40,000 in accumulated depreciation, leaving a book value of $60,000, we decide, no, this particular asset is going to have a much, much longer life. Well, not much longer, but another 15% longer. So we're going to change that to 23 years. And then at the end of it, we're going to be able to sell it for $7,500. So we're changing not only the useful life, but the residual value. You just recalculate. The new depreciable base is the $60,000 book value minus the $7,500 new residual value, divided by the remaining years. So from year 9 to year 23, 15 years. That gives you depreciation expense for the current year and going forward of $3,500. All right, we'll do lots of examples like this on Tuesday. Change in reporting entities, as I said, you have to. I mean, this is one of the reasons that accountants of acquired companies are normally the last ones laid off, because it takes forever to close out the books. So the people in AirTran, which I think is headquartered down in Miami, I guarantee you the accounting department is probably fully staffed. They're working as we speak, because it will take them a long time to completely close down and get all of the books transferred to Dallas. Actually, it transfers to San Antonio. Southwest Airlines accounting department is located here in town. So the rest of it's up in Dallas. Or at least it used to be. I don't know if it still is. I think it still is. So they used to do all the accounting down here. Because Herb Keller, the guy who started it, he lived here in San Antonio. So he used to commute back and forth every week on one of his airplanes, but still, you know, it was pretty easy to do. So yeah, he had a house up in the hill country, and may still have a house up in the hill country. All right, so you have to go back and restate the financial statements, and you also got to get all that through audit. Because when you do one of these retrospective combinations, the auditors have to come in and audit everything you're presenting. So now, especially when there's normally, well, not always, but normally, the two different companies, AirTran probably had a different auditor than Southwest did. And so now the newly formed, bigger Southwest Airlines auditor has to go back and attest. And even amongst the big four, if one was KPMG and the other one was EY, KPMG is not going to trust EY's work papers. They're going to want to do as much of that work from 2 years ago as they can. So it's kind of funny. I have had this happen many times in my career. The aerospace industry is constantly trying to gobble up people. All right, then correction of an error. Once you identify the error, then you need to make the correction. All right, so more common, you've recognized revenue that you shouldn't have. You've not recognized an expense that you should have. It's funny how that works out. Companies rarely don't recognize a revenue or do recognize an expense that they weren't supposed to. It's always the other way around. You've got a liability that you should have recorded, but you didn't. Things like that. All right, there are 3 types of errors. There's errors that affect only the balance sheet. All right, these are classification errors for the most part. You received a note receivable and you accidentally debited it to accounts receivable. Okay, it's a change, but it is an error. Errors that affect only the income statement. Once again, a classification error. Or one that affects both. And this is where the most common errors affect. You know, you recognize some revenue that you shouldn't have. Well, that overstates accounts receivable and it overstates revenue. God bless you. All right? So, as far as balance sheet, this is that note receivable, accounts receivable, you just restate it. It only affects you don't need to make, it doesn't affect retained earnings because it's just the classification error. Yes, it is overstated. Let's make the assumption that the note receivable is due farther than a year in advance or a year from the balance sheet date. So yes, it is overstated current assets and understated investments. But it's just a classification. Just move it on the existing financial statements and go on. Okay? Income statement only. You accidentally credited interest revenue with sales revenue. So you've overstated your gross margin. You have overstated your income from operations. You have understated your other income and expenses, other revenues and expenses. Once again, it doesn't affect net income. It doesn't affect retained earnings. It's just a reclassification. Just fix it on the financial statement and move on. No journal entry is needed. Well, there is a journal entry needed. You've got to debit the interest revenue and credit the sales revenue, but you don't need to make an adjustment to retained earnings. All right, now this is the one that you have to give some thought to. Income statement and balance sheet. These are either counterbalancing or non-counterbalancing. Anybody got a guess as to what counterbalancing errors are? No?
The thing that, even though
No, it fixes itself in the next year. All right? You do inventory under a periodic method. So at the end of every period, you go out and you count all of the inventory you have to come up with a calculation for ending inventory. You then subtract that from the total goods available for sale, beginning inventory plus everything you purchased during the year, and that gives you cost of goods sold, right? So what happens if your inventory people forgot to count a shelf or a whole room? Happens. Just trust me, it happens. Because there isn't an inventory person alive, or there's not a stock person alive that likes doing inventory. Because for one, it's the one time a year the accountants are down in their area. They don't want to see us. We don't know what we're doing. We're picking stuff up, and what is this? Where's the tag? How am I supposed to barcode this? I don't know what it is. And they roll their eyes and they go, "That's a such and such." Well, how am I supposed to know that? So if you forget to count this room, what has happened with ending inventory? It's understated by that room's value. That then overstates cost of goods sold because you assumed you sold it if you didn't count it. That is then understating gross margin and understating net income. But what happens the next year? Because now ending inventory becomes beginning inventory, so it's still understated. So the following year, they do count the room. Now, for that year, inventory is properly valued, but goods available for sale is understated because of the understatement of ending inventory, and now you're going to overstate the cost of goods sold. And now your net income is, you're going to understate cost of goods sold. You're going to take too much profit that following year, and it's going to be the same error, and it's going to equal out. Okay? So that's a counterbalancing error. They automatically correct. There are those that never offset, and I don't like the example here. Well, I'll show you the example. Here's a counterbalancing. This is just basically, you didn't accrue $2,000 worth of interest. You've got a note payable that is due in January, and it has $2,000 worth of interest that should have accrued back on December 31st. Well, you didn't turn around and debit interest expense until you actually wrote the check. And then you debited interest expense, you debited the note payable, and credited cash for the entire amount. Well, last year, you understated interest expense, which overstated net income. In the current year, interest expense is going to be overstated by the same $2,000 error, and it's going to fix itself. By the end of year 2, retained earnings will be correct. So at the end of year 1, revenues are right, expenses are understated, which overstates net income. Liabilities are understated because you don't have an interest payable on the books, and you've taken too much into retained earnings when you closed out your net income. In the following year, now, expenses are overstated by the $2,000. Net income is now too low, but everything on the balance sheet side is fixed. So that's a counterbalancing error. A non-counterbalancing, and I don't like this, and I'll tell you why. Let's say you bought a long-term piece of property, plant, and equipment and accidentally just wrote the whole thing off as supplies. All right? Well, one, I'd be yelling at my accounting manager and my assistant controller and my controller as to who in the world allows $10,000 to go into supplies and nobody notices. I mean, you can imagine what your budget that month looked like. Okay? So, but what it should have had was $1,000 worth of depreciation. So supplies expense is overstated, depreciation is understated, net income is understated by the $9,000 because you've expensed too much. Retained earnings is then understated. Property, plant, and equipment is too low by 10, less the accumulated depreciation of 1. So all of this, and they're giving this as a non-counter. 10 years down, if this was a 10-year asset, this eventually counterbalances. Because you would have taken $1,000 worth of depreciation, and eventually it fixes itself, but not for a long, long time. All right? You received a prepayment, and you recorded it all to rent revenue rather than unearned rent, because you received it during the last month, and this isn't for a piece of wherever it is, an office or some warehouse, something, whatever it is you're renting, doesn't really occur until next year. So this is how you need to fix it. You need to reduce retained earnings and then set up the proper rent revenue for the current year, and that's the error. So we'll do a lot of those. And then on the final, this is what I'm focusing on. Changes in estimates and changes in errors. I mean, it would be almost impossible to give you a change in a reporting entity. And I'm not going to have you guys go through a calculation of FIFO, LIFO. That's just beyond the scope of a final exam. So, okay? So that's probably the easiest chapter in the whole book. I've said that before, though, haven't I? What did I say that for?